The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
With so many people living longer, the fear of outliving your money becomes a reality for many of us. Will I be a financial burden? Will I outlive my money? How will I be remembered? My name is Neil Himmelstein, president of Main Street Planning Group. Please contact me by visiting mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. I will introduce you to strategies that will guarantee you will not outlive your money, that can guarantee you will not be a burden on your loved ones. Through a collaborative approach, we will uncover solutions that offer tax-efficient strategies, lifetime income, and legacy planning, choice, organization, direction, and education. That is the code we stand behind. Contact mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. And listen to me every Friday at 3 p.m. as I host the Main Street Code for Financial Success, right here on 103.9 LI News Radio. Good afternoon. Welcome to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. I'm here every Friday at 3 o'clock. If you miss an episode, you can check me out at themainstreetcode.com or Apple, Spotify. We have all our past episodes, and we try and keep current with what's going on with you. When we talk about our code, we talk about choice, organization, direction, and education. And we help hundreds of advisors, accountants, attorneys across the United States with insurance planning and financial planning regarding your lifestyle and retirement. Very important. We are independent insurance wholesalers specializing in life insurance, disability insurance, long-term care planning, annuities, and life settlements if you are to sell a policy because it's can't afford it anymore, it's getting old, and it's not what you expected it to be. Today I really want to talk about one of my clients who's 79 years old. He's not in great health. He's making a ton of money. His wife had passed. One of his daughters had passed. He still has another daughter. And every year he keeps putting money away into his retirement plan, every single year. So now he's sitting with several $1 million of IRA money, basically, or 401k money. And his accountant, I've never spoken to his accountant, but I'm encouraging him to have a meeting with his accountant, is he keeps, because he's still earning good money, he keeps putting money away into his retirement vehicles. He's not in good health right now. And basically, accountants in general are wonderful about teaching you how to accumulate money and defer taxes, but eventually you have to pay them. So it's really not doing him any good, because now what I've suggested to him, he has several $1 million in retirement. Let's work out a plan where you can schedule the taxes you pay for the rest of your life, rather than saying, okay, this year I need $100,000, so I'm going to close out one of my annuities. Well, that's 100% taxable to you because you took the tax deduction on it, 2 years ago. How's that helping you? Plus, you're still making income, so that boosts your income level. So he's at the top income level now of taxation. Deducting money is not really helping him tax-wise. It's only creating more taxes for the future and for the next generation. So I don't see where the savings is. You'd be better off accumulating money in a Roth or something where you could take the money out tax-free down the road. At this point, he's not using any of his retirement money. And so what I suggested is, one of the solutions we have is take some of the money or part of the money and create your own pension by buying an annuity that pays you an income stream for the rest of your life, so you have this coming in every month. Now, at his age, we were looking at generating an income of $18,000 a month for as long as he lives. And if he doesn't use that money, I structured it around the whole Secure Act 2.0. His daughter has to take that money over the next 10 years, whatever's remaining. So I made a unique structure with an annuity company that said, okay, we're going to pay him this for as long as he lives. And if he doesn't use up that money, then his daughter will get a monthly income, that same monthly income, for the next 10 years. And if it's still not used up in year 9, the insurance company is going to make a lump sum payment of the balance to his daughter. This is tax planning not just for him, but for the next generation. Because all this money, if inherited, is 100% taxable. Which brings me to pensions in general. Pensions, IRAs. Let's say you're with a company. Let's say it's the federal government and they're forcing a layoff. I'll use them as an example because there's been so much tumultuous activity with layoffs, with early retirement, or anything else. And they're offering you early retirement. Well, part of what the government has, part of what school systems has, part of what many major businesses used to have is some sort of pension that they give you. Now, that pension gives you choices. And these choices are the most important choices you can make in retirement. The main choice they give you is, I'm going to give you an income. For what they're doing is they're buying an annuity. People don't realize, annuities are bad, annuities are good. That's what a pension is. It's an annuity. An annuity is a payment stream that's offered. Now, typical pensions will offer the following streams. One, you could take a lump sum. That is the worst thing you can do, is take a lump sum of money. Everybody says, I'll take a lump sum of money and I'll invest it. Well, what happens is that entire lump sum that they may offer you is 100% taxable to you. So do you want to take all your taxes at once? So if somebody gave you $100,000, what's that worth? That may be worth $50,000 to you. That'll get added on to your income if you're still making an income through other sources or everything else. That will get added in, so that may boost your tax bracket up and further depreciate all that money. So lump sum is an option. The main option that's provided, and this works for some people, it doesn't for others, is they'll give you an income for life, and then your spouse will get that remaining income. This is off of that based income, just like I told you. They'll offer you a joint income for as long as you both live. They call that 100% survivor option. Or they'll give you a higher amount if you take an option that you'll get a higher amount every month and your spouse will get 50% of that income till she passes. Or they'll give you an even higher amount if they just give you an income, and then when you pass, there's nothing that remains. These are all annuity payout options. And what's best for you is where a lot of planning needs to be done. Now, it used to be when those pension options were made, they were great. You'd make a decision, and they were pretty good. Now we can even compete with those pension options and say, hey, we can give you a product, an individual product that's designed for you that will meet or beat those options and ensure that you get the most money in a most tax-favored way. Very important. It's all about taxes, and it's all about net income. It's great if you have $2 million or $1 million in retirement, but when you distribute it, how much of that are you going to keep, or how much of it are you going to pass on is the game that most accountants don't talk about. We do. We don't just talk about accumulation, we talk about distribution, whether it's distribution to you and your lifestyle, or to your next of kin, or to your heirs. That's the important factors. That's the decision that has to be made. So you make a decision. Now, the basic decision that if you not knowledgeable is, well, let me give 100% income to my wife as long as she lives. The problem is you give up a lot of income when you do it that way, And typically, in most scenarios, you and your spouse are near the same age and may pass around the same time. So you've given up all that income. So there are ways that we can talk about maximizing your pension, but we're running out of time. And I mean, right after the break, we can go into it a little bit more. We'll go about maximizing your pension and maximizing your distributions. Very important. And making sure that we're tax efficient, not only as we're accumulating, but as we retire and even after we pass. You're listening to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. Best way to reach me is 631-647-4694. That's 631-647-4694, and we'll be right back. Welcome back to the Main Street Code, and I'm your host, Neil Himmelstein. And prior to the break, we were talking about pensions and retirement and distribution spreads on how we distribute our money in retirement. And one of the things I was talking about was maximizing your pension. Now, you may have a pension or something that you're about ready to retire, and your company or the government or the school system says, hey, we're going to offer you this income stream or death benefit. And if you don't seek out an advisor, then you're making a mistake. That's the time to reach out to us and really talk to us about how do we maximize that. So we were talking about the different payout options that they'll offer, which is an annuity stream, whether it's what they call joint and survivor or joint and survivor 50% or 100% to you. And the considerations are, how is your health? How is your spouse's health? If you're not married, you might want to just take out income for yourself and maximize that. What if you're both healthy and you both are younger and you're going to, these are different considerations. One of the things we recommend, which makes a lot of sense financially, is to take, if you are married, is to take the maximum amount for yourself and buy some life insurance with the difference of money that would have been joint and survivor, and then you can leave a big tax-free amount of money to your spouse and still take the same amount as if it was joint and survivor. Because a joint and survivor option inside an annuity is really life insurance. That's the internal gamble that the insurance company is doing with you. So based upon your age and how much you've put away, these numbers are tricky. I mean, it's kind of complicated unless you dissect exactly what the offer is, and not many people can really dissect exactly what's best for them. That's why we're here. That's how we help you, is we're going to dissect that. And at the same time you're doing all that, and we maximize your pension, now how are we going to protect it for the next of kin or even for ourselves? What if my wife gets sick and I have to stay home and take care of her? What if the husband gets sick? What if one of us gets sick? What if both of us get sick? Who's going to take care of us? Who's going to protect us? How is this income going to help us? Do we need additional income or additional protection so that we don't have to use all that income just for our care? Because we still may own a house and, or apartment or whatever it is. We still have bills to pay, and we still need to take care of both things. So how do we do that? So one of the biggest tragic areas that happen in retirement now is the need of long-term care. It's because they can figure it out medically how to keep us going for a long time, but in what capacity, in what health? The last thing we ever want to do is go to a nursing home or be forced out of our own environment into some strange cold place. Nobody wants that. That's the bad place. We get it. I understand it. Nobody wants that. But I have to fend that off somehow. I have to fend it off financially and emotionally to say, hey, how can I stay in place best? And that's where money comes in, and that's where maximizing your pension comes in. That's where getting long-term care protection or strategies to protect your money come in, and that's where we play very nicely. Whether it's a solution with long-term care and life insurance, whether it's a legal solution, whether it's a combination. And also the accountant needs to be involved, because if the accountant keeps, there are what we call tax preparers and there are tax planners. And I'd venture to say that most accountants today are tax preparers. They see you once a year, and they're not really tax planners. As a matter of fact, they're so busy, they can't hire enough people to handle what they're doing. So it makes it very difficult for them to really dig in deep to your individual financial plan and do tax returns. There's just way too many deadlines. They got a deadline every month for corporate. They got a deadline for personal. They got a deadline for this. Unless you have a dedicated person who's really well-rounded and knowledgeable, and I'm finding it's fewer and fewer between. I'm finding some really great ones, but they may be really good at saving you money today, but looking out 10 years, 20 years, 30 years, next generation, they don't really have the time to delve like we do into those areas. And that's where a lot of your insurance planning comes in. And that's where a lot of the legal planning comes in. And the problem with even the best estate attorneys, and I have many in my bullpen that work with us on a daily basis, is they may set up a trust. You may not put the asset in the trust. You may forget what that attorney said. You may meet him once a year. You may meet him once every 5 years. You may meet him once and say, okay, I'm done. Forget about it. And that's not the case. Just like buying a life insurance policy, I say every week, most people, they'll buy it, they'll put it in their drawer, and they'll forget about it. They'll do an estate plan with an attorney. They'll meet with the attorney. They'll do the great plan. Oh, this great plan. We're going to do this, that, and the other thing. It's not executed completely. It's partially executed. Everything's great. And people think, okay, I'm done. No, you're not done. Things change. The laws change. Everything changes. Your life insurance policy changes because if you have a permanent policy, it's dependent upon the cash. It's dependent upon funding it correctly. It's all these little variables. The ownership is so important. If you have it owned by something other than a trust, people don't realize that can be a taxable asset. Even though it's federally tax-free, it could be part of your estate. It could be a mess. So ownership issues are always an issue with life insurance. Even when you set up a life insurance trust, many people set up the trust and they don't put the policy in. The attorney said, I did my job. I set up the trust. Great. The insurance guy said, I did my job. I set up the insurance policy. Great. But if you didn't put that policy inside the trust and the ownership is you didn't do a good job. Somebody missed it. And at the end of the day, who are you going to call? Who are you going to blame? You got to blame yourself in one respect, but, the attorney says, I did my job. I set it up. The insurance guy says, I did my job. I set it up. The accountant says, I did his taxes. I set it up. You just didn't implement it. Well, we help you implement and put all those pieces together because there's nothing that's cookie cutter. Nothing. And laws change. Now, one of the big laws that have changed that we're going to delve into on a later program is if you're an employer with 10 or more employees, you have to have a retirement plan starting 2026 in the state of New York. This includes part-time employees. Now, if you run a restaurant, if you have a seasonal business, you're out in the Hamptons and, you got people and you hire 50 part-timers. Well, guess what? You have a farm and you have a lot of part-timers. Well, there are requirements from the government that we're going to delve into with a retirement expert and talk about that you need to have a plan. Now, there's going to be a government plan, and usually the government plans are more expensive and have less options. So I suggest, A, if you have a plan, go through your plan document, make sure you have a copy of it because things change. The laws have changed. You may be in or out of compliance. Now, you could go on and be out of compliance and not do a plan correctly and have a plan. And guess what? The government's going to come in and fine you. Fine you big. Because there's two ways of the government getting money from you. One is through taxes. The other is through fines. We have to pay taxes. We can defer. We can try and deduct. We can do this. We can do that. But if you're out of compliance, they can come in and shut you down. So we like to keep you in good shape. You've been listening to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. I'm here every Friday at 3. Best way to get a hold of me is 631-647-4694 or visit me at themainstreetcode.com. Have a great weekend, everybody. Thank you.
The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.